Good afternoon, my name's James Gerrish and welcome to a quick direct from the desk. It is Monday afternoon, the 26th of August, and I just wanted to touch base around the Market Matters Platinum portfolio and discuss some of the positions that we've got in the portfolio at this point in time. Before I begin, I just want to reiterate that the advice provided in this presentation is general advice only and you should consult a financial professional before taking any information on board. Again, it's general information only. So in today's quick presentation, I want to update our views around the Market Matters Platinum portfolio. I'll look at the income portfolio on Wednesday, and over time I'll look at the international equities portfolio and the international ETF portfolio as those portfolios progress. So right at this point in time, we're coming towards the end of the full year reporting season. It's been a pretty difficult one for some of the positions in the Market Matters Platinum portfolio, and I want to focus on those positions today. We're also commenting in broad terms just around the portfolio generally. So I'm going to if I'm focusing on the tougher positions in the portfolio, I want to outline my approach around some of these positions. So Costa Group came out last Friday with a first half set of numbers. They're a December year end. Essentially, they said that they would meet the lower end of the revised down guidance they provided only a couple of months ago. That came as a negative shock to the market on Friday. The stock was down 16%. It had rallied 8% the day before the day before the result, so there was some optimism built into the market ahead of the result. But alas, they disappointed the market more around their guidance. So just to take a step back, Costa are the biggest producer of citrus, mushrooms, blueberries, raspberries in Australia. There's a couple of main things impacting their business at this point in time, and I'd stress that they are shorter term cyclical issues rather than structural issues hurting Costa at this point in time. They've obviously got issues around mushroom pricing, raspberry quality, blueberry prices. They've had some issues around high water costs in the shorter term. Agricultural businesses have many headwinds in the shorter term, but the longer term thematics around the demand for food, etc., remains in place. Costa's done a good job in the years gone by of developing a really robust, sustainable business. They've got a strong balance sheet, etc., and that's all in play. These shorter term issues create some uncertainty from an earnings point of view, and I think that's the main takeaway from the first half results that we saw from Costa last week, that over the next 6 to 12 months, it's going to be a really difficult task to predict the earnings of that business going forward. We've got a 6% weighting in the Market Matters Platinum portfolio. We're down about 36%. It's not an ideal position in anyone's language, but I remain positive on the business in the longer term, but I'm cautious on the position size that we have in that portfolio. So the likely course of action at this point in time would be trimming the position rather than exiting the position and giving a smaller position more room to move over the next 6 to 12 months as that business progresses. So seasonal factors hitting Costa Group. It is an agricultural play, and that's obviously provided a near-term headwind for that business. ABC, or Adelaide Brighton, is a building materials company that we have in the Market Matters Platinum portfolio. We've got a reasonably small position. We bought just ahead of this downgraded earnings guidance, which was extremely disappointing. The stock came out and downgraded earnings. It dropped to $3.50 or thereabouts on the day of the earnings downgrade. We should have sold, though. On that day, we didn't, in hindsight. And now we're looking at the position which is down around 30%. The construction sector is weak. We know that. The cement demand, which obviously Adelaide Brighton is a large cement manufacturer here in Australia. Cement demand has been weak, and I doubt a near-term rebound will happen in the near term. It was interesting listening to Bingo Industries at the back end of last week on their conference call, just around the underlying earnings drivers of their business going forward. Infrastructure spending is a really big driver of their earnings going forward, but they did make commentary around the delay in some large infrastructure projects starting, and I think that's going to have an ongoing impact in terms of Adelaide Brighton's business. So at the time, at this point in time, I see earnings risks as too high in this business. So we're likely to cut this from the Platinum portfolio, take our medicine, and move on. Emeco EHL is a earth-moving rental business that we have in the Platinum portfolio. While it's not down marginally, it has pulled back after results that were out at the back end of that were out last week. Again, this stock rallied into the result, so there was some optimism being built into the market. Subsequent to the results, the stock has been sold off. The top line numbers, or the earnings numbers for FY19, were positive for Emeco. They beat in terms of earnings. They beat in terms of gearing as a big issue in terms of Emeco. They beat in terms of their gearing levels that they'd guided to the market. If I look around what brokers have been doing post the results, Bell Potter was positive on the stock. They increased their price target from $2.63 to $2.69. Shaw and Partners, where I'm at, although we decreased our price target from $3 to $2.80, we kept a buy in the stock. It's trading on 9 times FY19 earnings, under 8 times FY20 earnings, so the stock's cheap. I couldn't quite work out why the stock has been under pressure post those earnings. Perhaps it was around the lack of financial earnings guidance going into FY20. But again, the business is priced cheaply, and it's got a real turnaround process in place. So if we didn't have a position in Emeco, or such a large position in Emeco, we would add to it at this point in time. Orocobre, which is a lithium company, lithium stock here in Australia, that has been under significant pressure over the last little while. We bought this stock about 3 to 4 months ago. It hasn't worked out for us. It's not a stock-specific issue in terms of Orocobre. It's a lithium issue. The global lithium sector is been under a lot of pressure. If I bring up an ETF which tracks the LIT US, which tracks the global lithium sector. So it's a global ex-lithium and battery tech ETF listed over in the States. It gives you a good trend around what's happening in the lithium space on a global perspective. The lithium stocks globally have been under a lot of pressure. I think we've simply got our timing wrong about going into lithium. The lithium price has been under significant pressure. It's about half of what it was only about 18 months ago. So while this downtrend and while this weakness in lithium is playing out, we're simply going to cut the Orocobre position, ORE, and move away from that stock. Janus Henderson, JHG, is the fund manager that we've had in the portfolio for a while now. It's been an underperformer. It's been a drag on the portfolio for a while. We're not going to cut this position for a couple of main reasons. So we've got 5% position in the Market Matters Platinum portfolio. This is an incredibly cheap stock. It's trading on 7.5 times earnings. It's going to yield 6 to 7%, and I think that yield is sustainable given they've got an on-market buyback, an ongoing on-market share buyback going on. They've got an improvement in the fund performance of their fund. So, fund flows for fund managers, and Janus Henderson is a big fund manager globally. They have nearly $360 billion of assets under management. But again, performance is the key in this business. So the move from active management into passive management is obviously a pretty topical one at the moment, and it is happening. There is, those active managers that can't perform have been shown the door, and passive managers have been put in their place. That's what's been impacted Janus Henderson. So it goes to show that performance is a really key indicator or a key measure of why funds leave. So if performance turns around, then more FUM is likely to stay. And Janus Henderson's performance has started to turn around. The stock's cheap, and it has started to see some of those metrics in the business that we look for have started to turn. Pact Group is the other one in the portfolio that has been under a little bit of pressure post their earnings results. They came out with earnings that were slightly below market expectations. Their guidance was a bit more somber than perhaps the market was anticipating. Pact Group is a packaging company that we bought as a turnaround play. It's incredibly cheap, but it's got its few curly issues around it. It's got some balance sheet issues, and the fact that FY20 earnings guidance was probably not as upbeat as the market had anticipated. The market was sitting at around 9% earnings growth in FY20. From their commentary, while they didn't give specifics, it sort of implied that mid-single digit earnings growth in FY20 as the business turns around. That reduces their ability to pay down debt over that period and increases their possibility of needing to raise equity. Now, I don't think they will need to raise equity. They could. That is a risk that we have in that stock. But again, it's incredibly cheap, and I think that business is starting to turn around. So, look, we're not in a bad position in Pact Group because we've only bought it recently. We've averaged it into weakness, and I think that business, if we didn't have the position that we've got, we would be buying here. I wrote about it in the report this morning that I can see at least another 20% upside in terms of Pact Group. So that's certainly a business that we're holding on to. If I think about the other stocks across the market matters Platinum portfolio, I'll just take that off the screen there. We've got a number of the miners that we've bought into recently. So BHP is the obviously the big boy in the room. We sold that at $41. We're back buying that at $35.52 as of last week. It's slightly lower than that. We're looking to add another 2% into that position if it can trade around $34. So right now $34.69. We're looking to add to BHP rather than anything else. Fortescue reported their full year 19 numbers today, and it was a pretty solid result. It was a record result. Profit above $3 billion. They've paid a full year 19 dividend of $1.14, which is pretty astronomical considering that back in January of 2016 the stock was trading at $1.34. So look, a phenomenal effort by Fortescue Metals, and we've bought this stock recently into weakness with a 5% weighting, so we remain comfortable with Fortescue, and the same can be said to Rio in terms of the recent purchase of a 5% position in Rio. We're comfortable with that position. It has paid a dividend after buying that position in the Platinum portfolio. And if you think about the exposure of these mining companies to the trade-related issues that are playing out between the US and China, these are leveraged to global growth. Global growth has taken, or expectations around global growth have taken a big hit courtesy of Mr. Trump and the Chinese trade war playing out. A resolution there or improvement there will see these resource companies bounce, and we're positioned now for that. Domino's Pizza is another interesting position in the Platinum portfolio, and one that had, going into reporting season, it was a little bit of a risk. The market, this has been a much loved growth story in the Australian market for some time. In the last 12-24 months, the love has come out of Domino's in a pretty stark way. It's traded down from nearly $60 to around $35. It's now at $42.72. We bought around the $40 mark. Their guidance while the financial metrics for FY19 were a slight miss to expectations, their guidance for FY20, particularly around their trading update for the start of FY20, was strong. And of particular note is their international businesses are starting to show some form. The ANZ business is a mature one, but the international business is what's going to drive Domino's growth going forward. So I remain comfortable in Domino's, looking for $48 as our initial target in terms of Domino's Pizzas. Blue Scope Steel, this was added to the portfolio recently. They reported last week. They were originally hit on the back of that. They said that expectations for FY20 would be for earnings decline of 45%. The market was about 40% decline. It's all around steel spreads, etc. So they're known knowns. The market got it wrong initially, sold the stock off hard, and is now bidder back up. We remain pretty comfortable in terms of our BSL position, expecting higher prices in the near term. If I think about other stocks in the portfolio, we've got Orica, which is the explosives business. However, it's now more of a technology business. They've invested heavily in technology over the last couple of years. That's starting to bear fruit. So in the last week or two, they've taken a slight hit in terms of the share price, dropping from above $22 to around $21. They reported well, and as I said, this technology investment they've made over the last couple of years is starting to bear fruit. So we remain bullish in terms of Orica, and the banks are the other holdings that we've had, along with Tabcorp. So if I just touch on Tabcorp for a moment, this is our sort of position that will benefit from tougher economic conditions. Their lotteries business is going particularly well. Their wagering business has got some competitive pressures, but it's really the lotteries that are driving Tabcorp's earnings into FY20 and beyond. So 450 loves a down market, was up when the market was down 100 points today, was up at the back end of last week. So Tabcorp to me looks bullish. It's more of a defensive yield play, which is a good segue into the banking space. The banks as a collective, we have a reasonable position in the Platinum portfolio within the banking space. As a collective, you think about banks and their earnings stability, sustainability, and that'll flow into whether or not their dividends are sustainable. At this point in time, I think that the earnings of banks in Australia are sustainable. As a consequence of that, I think their dividends are sustainable. And given the low rate environment, those dividends become attractive. And I think CBA can trade up to a yield somewhere around the 4.5% from where it's trading at now, given that it's according to Bloomberg expectations, CBA's sitting on a yield of 5.6%. So if it trades up to a yield of sort of 4.5%, it's got significant upside in terms of the share price for CBA, and I think the other banks will follow suit. So I'm reasonably optimistic in terms of the banks, particularly around the relative appeal of their yield. Anyway, I just wanted to give you a quick update across our thoughts in the Market Matters Platinum portfolio. In summary, in some of our more difficult positions in the portfolio, we've got Costa in the portfolio, which we like longer term, but the position size does concern me slightly given the uncertainty or unpredictability of earnings going over the next 6 months or so. We're looking at trimming that position down to a more manageable weighting so we can give that position some more room. We're looking at cutting Adelaide Brighton. I don't think that business will turn around or rebound anytime soon. There's also consequences for CSR in our income portfolio that I'll touch on Wednesday, but we're looking at cutting ABC, Adelaide Brighton, and we're also cutting Orocobre simply because the global lithium trends are so weak, and it doesn't look like turning around anytime soon. In terms of Janus Henderson, we're likely to hold that one, but if it does rally from here, the 5% weighting will be trimmed into strength, and Emeco will be held for now, and to me that looks like a really cheap opportunity to get a good growth business over the next 12 months, along with Pact Group, that if we didn't own such a significant position in that business at the moment, we'd be adding to it at these levels. We're bullish in terms of Pact Group, and then the rest of the stocks are as per programmed. I'll be back on Wednesday to talk you through the income portfolio. As always, if you've got any questions about the portfolio, we're happy to answer them through the info@marketmatters.com.au email address. Please keep them coming for Mondays, and have a good trading week. I'll speak to you soon. Bye for now.